come get each one of these stacks up here in the front.
Oh, okay. Thank you.
Finance project.
A lot of people not here. Okay, so, tonight, our lecture is going to be on chapter 7, which is the chapter on liquidations. It is not a very long chapter. It's not going to take the entire class period. And then we will start on what I call 11:20 day, which is gonna take more than a day, but really all we're doing in that is I want to cover some topics that are not, I feel are not covered in this text very well, things that you should know and are tested on the CPA exam and are very relevant to what you need to know as tax accountants. So that's kind of what I've done, and when we get to that point, after we finish the discussion on chapter 7, I have some PowerPoints that I made, which are on D2L, that we'll use to help in our discussion, and then we're going to do some problems and a simulation. So, and I know some of you took reg last semester, and some of that stuff you've already seen, but it doesn't hurt to look at it again for sure. Let's see. So, has anybody taken a look at the 469-page tax bill that came out last week?
I've read articles about it. I haven't really looked at it.
What do you think about it?
They've had some hidden stuff in it that's come up. Like I remember reading that they had like some kind of hidden tax bubble that almost made a certain percentile get up to almost 50%. And that they're trying to make it simpler, but it seems like it's not going to get any simpler depending on what they do.
Yeah, I know. So some of the big things that are out there, please know this is in no way finalized. They're saying their goal is to finalize it by the end of this year. I don't know. I think once it gets to the Senate, it'll get torn up. As in, they'll just tear it up. It's like the Senate likes to do. I did a 6-month internship in the Senate, so. But it's interesting. One of the big things that's out there is they've reduced the corporate tax rate, the highest rate, from 35% to 20%. So that's a significant reduction. Now, pass-throughs, which we will get to here very shortly, we'll probably spend 2.5, 3 weeks on S-Corps, which is a pass-through entity. So pass-throughs, you're essentially taxed at your own rate for individual income tax, right? Because the income passes through to you, and if you are an individual shareholder, which you have to be for an S-Corp, you can't have a corporation or a partnership that's a shareholder of an S-Corp. And we'll talk about that in a couple weeks. But if you have an individual shareholder, they are taxed at their ordinary income rates, which under current law and in the proposed law, the highest rate for individuals is 39.6%. So what this effectively means with the lower rate that's been proposed for corporations is it might make people start rethinking, do we want to be a corporation or a partnership? So, something to think about. There is and as part of the proposal, there is a proposal of it says a capped amount of 25% for individuals that own pass-throughs. That's still lower than 39.6%, right? But keep reading. There are all these exceptions. It doesn't apply to service-based companies, law firms, accounting firms, engineering firms, doctor's offices. Anything that is service-based, that 25% doesn't apply to. That's a lot of people, right? Service-based companies is a lot. And even if you're not a service-based company, there are all these like caps to that 25%. So it's really not 25% for a lot of people. It's just something to think about. I've always said in this class, if you think back to one of the first lectures I did, honestly, there aren't that many C Corps anymore. Why would you want to be a C Corp when you have two levels of tax, one at 35% and then the other one up to 25% for dividends, right? So there aren't that many companies that fall under that bucket that would want to be a C Corp. But with the tax landscape changing in the next year, it might be that people think C Corps are better, So, I don't know. We'll just wait and see what happens. If they change all these laws by the end of this year, teaching individual tax next semester is going to be a nightmare. I don't know how I'm going to teach it, because they're pretty much getting rid of all itemized deductions. So, we'll see. Okay. Something to look out for. Follow the tax news. Don't read all 449 pages, but it's, there's been a lot of things that they've changed. Okay, so, tonight, let's talk about liquidations. So I haven't, honestly, in the proposed laws that are out there, there's not a whole lot out there that would change the content of what we're doing in this class. Most of the proposed changes have to do with individuals. Not a lot has to do with C Corps other than the rate. So that's good to know. All right. Chapter 7, complete terminations. So, if you look on the first page of my outline, it basically defines what is a liquidation. And it's defined in the regs, specifically 1.332-2C, which says, when the corporation ceases to be a going concern and its activities are merely for the purpose of winding up its affairs, paying its debts, and distributing any remaining balance to its shareholders. So what we're saying is, okay, they're going to stop being a company, stop actively conducting business, and start winding up their affairs. It is not required under the tax code that all of the assets be distributed. Sometimes state law requires a complete distribution of assets. That's not required under the tax code, and it is okay to keep some of your assets. A nominal amount is what the regs say, to pay off debts or to preserve legal existence. Sometimes you have to preserve legal existence for a set amount of time for different reasons. So that's okay under the tax code. It can still be qualified as a liquidation. So the liquidation rules are found in really 331, 332, 336, and 337. So that's where we're going to be tonight for the discussion on liquidations. So corporate liquidations, the general rule is found under Code Section 331. So if we take a look at 331 in our code, so, if you look, who has their code book open here? All right, good. So y'all up here at the front. Jacob. So if you look, see what does it say? Right, it says Part 2, corporate liquidation, subpart A says what?
Effects on recipients.
Effects on recipients. So that means Code Section 331 gives us the tax consequences of the recipients of the basically of the liquidating distributions. So these are basically the shareholders. Okay, this is the tax effect to shareholders, which is covered under Code Section 331. Now, one thing I should mention, something you may need to know at some point in your career. The titles, so everything in bold, the titles to sections, the titles to the subparts, anything like that, that's not actually law. Okay, that's written by some clerk who's compiling everything after it is the law. So if you're ever making an argument, the title of the law is not actually, it has no precedent whatsoever. Okay, but it does help us, quickly identify what this section generally relates to. But you can't ever cite the title of a section as law. It is not the law. Okay, so what this says, 331A. Amounts received by a shareholder in a distribution in complete liquidation of a corporation shall be treated as in full payment in exchange for its stock. Notice there is no mention under 331A of any sort of non-recognition rules. That means that the shareholder in a liquidating distribution is going to recognize gain basically in exchange for their stock. So it's going to be the money or the fair market value of property received minus the shareholder's basis in their stock. Now, let me ask you, this comes up, people get it confused all the time. The corporation making the liquidating distribution, does it matter what their E&P is? No. So in Code Section 301, we learned about non-liquidating distributions. And remember, under 301, we have a dividend to the extent of E&P, then a return of capital, and then capital gain. Under Code Section 331, a liquidating distribution, the corporation's E&P does not matter. Because the shareholder is going to get sale or exchange treatment, right? That's what they're doing, is selling their shares for either cash or property. And a distribution happens one or two ways. One, the corporation sells its assets to third parties and then takes the cash and distributes it up to their shareholders. Or the corporation distributes the actual assets up to its shareholders. One or two ways. So that's why we say cash or the fair market value of the property received minus the shareholder's basis in stock. Code Section 334A says that the shareholder's basis in the property received is the fair market value. Okay. So the shareholder, if it's a liquidating distribution, do they recognize gain? Yes, this is not a non-recognition transaction. Can they recognize loss? What do y'all think?
No.
They can,
Oh,
because the code doesn't say they can't. So they can recognize a loss. Okay? The shareholder can. Okay? So we are not talking about the corporation that is doing the liquidating yet. We are just talking about the shareholder receiving the liquidating distribution. So they can recognize a loss. Now, what about if a shareholder assumes some liabilities or receives property subject to a liability? So, simple example would be, we have a shareholder with a basis of 10K, and they are receiving a liquidating distribution of 50,000. This is the fair market value of the property, and then this property is subject to a $60,000 debt. So the shareholder is going to assume this debt as part of their distribution. They're probably also, getting some cash along with it. But let's just say in this scenario, they're getting this property which has more debt than fair market value. So what this means is the shareholders, this is probably a bad example. It's probably going to get all screwed up. Let me change the facts for just a second, and then I'll go back to that. If we assume that the debt is $30,000, the amount of gain that what is going to be the amount of gain that the shareholder has? Let me start with that. So, what is our amount realized here for the shareholder? The fair market value of the property received. Well, here it is $50,000, but they're also taking on $30,000 of debt when this property is distributed to them. So really, the amount that they are receiving is not $50,000. It's $20,000, right? So we have an amount realized of $20,000 minus the basis of $10,000. Okay, which equals a $10,000 gain recognized for this shareholder. Now, this shareholder's basis, okay, this shareholder's basis in the property that they receive, what do you guys think? Is it going to be 50 or is it going to be 20? That's right, 50. You do get basis for debt. Always remember that. Debt does still produce basis. There's a very famous Supreme Court case that basically came to this conclusion. But this shareholder's basis is going to be the full $50,000 fair market value. It's not going to be 20. Because they're still getting basis for the debt that they've now taken on. Okay? So. Yes.
Is this only for like one partner, or is this for the full corporation? Like,
This is for the shareholder.
This is for the shareholder. We're talking about the tax consequences to the shareholder right now. We will talk about the tax consequences in just a second to the corporation, to the distributing corporation. So right now we're talking about the shareholder, which could be an individual or it could be another corporation, could be a partnership. We don't really know. But we're talking about the shareholder's tax consequences. All right. So if this debt, let's say that the debt was $60,000, okay? Now, if the debt was $60,000, it does say in this, by virtue of this Supreme Court case, basically, that the fair market or the new basis of this property that's received cannot be less than the debt, okay? So that means that $60,000 is going to be the basis in the new property. You can't really say the fair market value is the basis, because here, you're going to get basis for the debt. That Supreme Court case said that. So even if the debt is greater than the fair market value, the shareholder's basis is going to be the $60,000 debt. And I'm trying to think. They would actually have a loss here, because we would have a $10,000 basis, and then they're basically are kind of getting screwed. So they really are going to have a loss here because they're getting negative value. So, okay. Let's see. Now, there's another rule in here about different blocks of stock. So, and this is actually relevant to your writing assignment, your memo assignment, which is due next week. Don't forget, next Wednesday. Okay, so if you have a shareholder and they purchase stock, or they, not just purchase, but acquire stock, it can be in a 351 transaction, and they do it once and then do it again later, technically, that shareholder has two different blocks of stock. You'll have one block for the first purchase with whatever basis it is, and then the next block, which is the block that you purchase later, with a different basis. Why would this potentially matter? What do y'all think? So what happens if you hold stock for greater than 12 months?
It's a long term.
Exactly, it's long term. That is the only reason why you would track stock in different blocks. So you would say, we have one block of stock with X basis, block A, and then block B has different basis. It only matters if one of the blocks has been held for 12 months or less, because then one will produce long-term gain and the other will produce short-term gain. But once the shareholder has held both of those blocks for greater than 12 months, it doesn't matter, okay? You don't really need to track it because the tax is going to be the same, right? And I think in the fact pattern for y'all's memo assignment, I don't actually think I give you the Mr. Randy's initial basis in his shares. So when you're writing it up, you would just have to say, like, this new basis would be added on to his pre-existing basis as a separate block, or whatever. But it doesn't really matter with different blocks if you've held them for greater than 12 months. Okay, and on that memo assignment, so one of your issues is the accommodation doctrine. And there is a specific mathematical test that you have to do in order to determine if there is a 351 transaction. So, and the answer to that question affects basically the whole rest of the memo. So what I don't want you to do is make that one calculation wrong, and then the rest of your memo is wrong.
What doctrine was that?
It says it in the memo,
Accommodation?
the accommodation doctrine.
Okay, thank you.
So it says it in the memo. So, so what I'm telling you is, if you want to, I will allow it. You can email me after you have done the calculation. Email me your calculation and say, and ask if it's right. And I will tell you yes or no if it is right, so then you can proceed to write the rest of your memo. Because if you got that number, it's mathematical. The answer is either yes, 351 applies, or no, 351 does not apply. And if you get the answer wrong, it will affect the rest of the memo. So you can email me. Just don't email me and say, 351 applies. Is that right? Don't do that, okay? Email me and say, this is my calculation. This is the number I've got, so 351 applies. Or 351 does not apply. Yes or no, and I'll tell you. Okay. And it's very clear. Like, it's not, it's not a gray thing. It's very mathematical, very clear. All right. So, Section 346 basically says that liquidation can occur over a series of time. It doesn't necessarily all have to occur within the same year, so long as it is pursuant to a plan of liquidation. Section 453, which is entirely a timing section, okay, that applies in lots of situations, not just corporate tax. But what this code section says, and there is actually a new code part of it that came out. I want to say it's 453J. I've got it written in my notes. I think it's J. But what this says is, if you receive one of your liquidating distributions in year 1 and one of your liquidating distributions in year 2, even if they're all pursuant to a liquidation, you still have to calculate your gain basically evenly over that time period. So in other words, if we had a shareholder and they have a $20,000 basis in their shares and they're receiving a $20,000 liquidating distribution in year 1 and a $20,000 liquidation in year 2. This code section 453 says that we have to basically divide up our $20,000 basis and have $10,000 in year 1 and $10,000 in year 2. And then that means when we get our $20,000 in cash, we're going to have $10,000 in gain in year 1 and $10,000 in gain in year 2. That's what this code section says. However,
And that, I'm sorry, that only applies to liquidation?
yeah, liquidations.
Okay.
Yeah, we're talking about tax consequences to the shareholders in liquidations, not the corporations. We haven't gotten there yet. So, but please note, and this is important, there are multiple rev rules out there, but the big one that the book talks about is 8548. And this rev rule, the IRS has, in multiple rev rules, the IRS has said that they won't make you do this. What you can actually do is use all of your basis in year 1. So you would have $20,000 of basis in year 1, and then you would have your $20,000 of cash, which means you'll have $0 of gain in year 1, but in year 2 you'll have a 0 basis and a $20,000 cash distribution, which produces $20,000 gain in year 2. So please note we have different answers. The IRS writes rev rules. Congress writes the code. Congress trumps the IRS. However, the IRS is the one doing the audits. So if there is a taxpayer-friendly rule out there that the IRS has said they will follow, I would go with that one. You know, if that's the one you want to use. If it's more beneficial to your client to spread out that gain over year 1 and 2, then use the code. Whichever one is more tax beneficial to your client.
So you can do both?
You can do either, yeah. Because the IRS has said this method, they prefer this method, but the code says to use this method. So, until somebody brings it up into court, and a court says you can't do that, it's unconstitutional, or it's contrary to the code, and the rev rule is more favorable to your client, which clients almost always would prefer to pay, to have 0 gain now and 20 gain later. They want to defer as long as possible, usually. So, okay. So there's also some discussion in this book. Code section 453 also is the section for installment reporting. So if you, let's say you sell your business and you're going to get paid for it over 10 years, then this code section 453 allows you to recognize gain over that 10-year time period instead of recognizing it all in year one. It's a timing code section, right? 453 has nothing to do with how much gain you recognize. It's just when do you have to recognize it. It's definitely timing. So, and I don't want to go into much detail about section 453 in this class. I know there is a good bit of detail in the book. But basically just know that you can basically defer some recognition under the installment rules in 453. So. Okay, so let's look at a problem. We are only doing part A, B in this problem. This is on page 327 and 328, because the rest of the problem has to do with installment reporting, and I don't want to go into it. Okay, so. So in this problem, we have A, who owns 100 shares of Humdrum, which he purchased several years ago for $10,000. Humdrum has $12,000 of E&P. What are the tax consequences to A on the liquidation of Humdrum in the following alternative situations? Humdrum distributes $20,000 to A. So $20,000 to A. So usually when you see liquidations on a chart, usually how they're indicated is an X that's dotted lines and an arrow pointing up. So what that means is this company is going away and all of its assets are being distributed up to its shareholders. Okay, so $20,000 to A and a liquidating distribution. So what are the tax consequences to A here?
10,000 basis,
$10,000 in basis, yes.
2,000.
What do y'all think? What do you think, Russell?
Shouldn't it just all be a gains and full liquidation?
Yes. So if they're receiving $20,000 and they have a $10,000 basis, how much gain are they going to have? $10,000, right? It's a sale or exchange. Remember the code says we treat it as a sale or exchange. What about the corporation's NP? Doesn't matter, right? Doesn't matter. So we have a $10,000 gain to A. It will either be long-term or short-term, depending upon how long A has held her shares. Well, this is purchased several years ago, so it will be long-term capital gain. Okay? All right. And then part B. What result in A above if A receives $10,000 in the current year and $10,000 in year 2? So if we have $10,000 in the current year, so we have year 1, $10,000 in year 2.
If we go by, it's gonna be interest rate, 5K basis and 5K gain, and then 5K basis and 5K gain second year.
If we go by
If we-
what?
By Congress, with the Congress rule, and then if we go with IRS rule, they will recognize gain in a second year.
Right.
Hmm.
Right, so if we have, under code section 453, basically what we would do is say, she has $5,000 of basis in year 1, and $5,000 of basis in year 2, and if she's receiving a $10,000 distribution in year 1 and in year 2, she would have $5,000 of gain in year 1 and in year 2. If we're falling under the rev rule, she will have, under the rev rule, she can basically front load her basis. So that means she has a $10,000 basis and a $10,000 distribution in year 1. So that means she has 0 gain. And then in year 2, she'll have all of the $10,000 because she will have used up all of her basis. Now, I'd ask in this question, would it matter if there was not a plan of liquidation in year 2? So it does matter. There has to be basically a plan of liquidation to have the liquidation rules apply. Okay. If their distribution's over multiple years. Let's see. Okay, so that's it. We're not gonna do the other C, D, E, whatever they are for this problem. It all has to do with installment reporting, and you're not tested over in the 453 installment reporting rule. So, now let's talk about the tax consequences to the distributing corporation. So we were just talking about the consequences to the shareholder. Now let's talk about the corporation. So with the corporation, which is under code section 336. 336 is the section for the corporation. And if we look, 336A is the general rule. And it says, except as otherwise provided in this section. What does that mean? There are exceptions. Keep reading. Or section 337. We're going to talk about 337 later tonight. Gain or loss shall be recognized to a liquidating corporation on the distribution of property in complete liquidation as if the property were sold at its fair market value. So, general rule for the corporation. They can recognize gain or loss if a liquidating distribution. Now, what was the rule if it is a non-liquidating distribution for the corporation? Does the corporation recognize gain? What about code section 311B? Okay, which says that if the corporation distributes a property that's been appreciated, so with a $10,000 basis and a $30,000 fair market value, and if they distribute this property to their shareholder, is that corporation going to recognize any gain with this distribution? Yes, right? So 311B are basically our rules for non-liquidating distributions. Okay? Now, to the corporation. But what if the corporation was distributing a property with a $10,000 basis and a $5,000 fair market value, under 311.
No loss.
No loss, that is right, no loss recognition. Go to page 311 right now. And if you take a look, let's take a look at code section 311, not a bad idea. Let's take a look at 311. Turn to code section 311. That's right, page 47. It says, except as provided in subsection B, no gain or loss should be recognized to a corporation on the distribution, not in complete liquidation. What that means is, we have separate rules for liquidating distributions. All right, and then what is in subsection B? An exception, distributions of appreciated property, which is the example I just did. So, it's important to understand what the general rule is for non-liquidating distributions. The corporation has to can recognize gain, but cannot recognize loss. However, if it is a liquidating distribution, okay, code section 336, which is our code section that deals with liquidating distributions, says that gain or loss shall be recognized, unless there falls under one of these exceptions. So what is the difference to the corporation between the non-liquidating and the liquidating distribution?
They can recognize loss.
Yes, the corporation can potentially recognize loss. In either scenario, the corporation has to recognize gain. Now, if the corporation is distributing cash to its shareholders, do they have any gain? No. What's your basis in cash, right? Whatever it is. So it really only matters if you're talking about a piece of property, like an asset that you're distributing. If all you're doing is distributing cash, the corporation's not ever going to have any gain or loss, right? Because there's no built-in gain or built-in loss. Okay? This only matters when we're talking about some actual asset that's out there.
That's weird. In A, it says that it shall be recognized, but then under the limitations, it says no loss shall be recognized to liquidating corporation on distribution of any property.
Where are you looking at?
Page 56.
I know, which section?
The 1A.
Yes, you are right. We will talk about these exceptions right now. There are exceptions in this code section. And what these exceptions do, there's basically, there are kind of three exceptions. What these three exceptions do is turn off loss recognition for the corporation. So, loss recognition not allowed by the corporation. Please note, these rules only apply to the distributing corporation. They do not apply to the shareholder. Okay? We just talked about the rules for a shareholder, right? Do shareholders get to recognize loss in a liquidating distribution? Yes. Right? We are talking about the tax consequences to the distributing corporation. I put distributing corporation up here because your shareholder could also be a corporation. There's no rule that says it has to be an individual. In fact, it usually isn't. So that's why I write distributing corporation, just so you don't get confused. Because you could have a shareholder that's also a corporation. Okay? So, loss recognition not allowed. There are actually three exceptions, and Gaga was just talking about one of them. There is the exception under D1A, one little i's. there's the exception under D1A, 2 little i's. And there is the exception under D2. So these are 3 distinct exceptions. Now, again, what these exceptions do is we say if you fall under this, or this, okay, so this is or this, the corporation cannot recognize loss. Again, if the corporation is only distributing cash, does this matter? No, right? Because your basis in cash is whatever it is. So our gain or our loss for the corporation is basically going to be calculated by the fair market value of the property distributed minus the corporation's basis in that property. Basically, as if we're selling it to an independent third party at fair market value. And remember when we were just talking about the shareholder, I'll write this over here, our shareholder gain or loss is calculated by the fair market value of property received, including debt, okay, minus the basis in shares. Right? Okay. So, let's talk about this. Let's see, which one is discussed first in my notes? I want to go in the same order. So let's look at D1A first, since that's the first one in my notes. D1A. And then we'll look at D1, we'll look at D1A, 1 little I, and then D1A, 2 little I. So, the first thing to note, D1A, 1 little I. No loss shall be recognized, is on page 56, to a liquidating corporation on the distribution of any property to a related person. Okay? So, we must have a related person under, let's see what code section is referenced, within the meaning of section 267. Related person under code section 267, okay? And if we look at 1 little I, such distribution is not pro rata. Okay? Now, what about D1A, 2 little i's? Okay? It still has to be made to a related person, and the property is disqualified. Related property, related person, sorry, under 267, and disqualified property. Okay, so let's talk about these, and then we'll talk about this one here in a second. So, let's look at code section 267 and see who is a related party. Okie doke. Let's look at that. Code Section 267. Specifically, I think it's Part B. 267B. So let me just tell y'all, on the exam I just gave you, I had one question where I changed the facts to say that Frodo and Gollum were brother and sister, and I thought that would change the answer. And then come to find out, brother and sister are not related in the 318 attribution rules. At the same time as I was teaching those rules, I was teaching 267 rules in my individual tax class. In these rules, brother and sister are related. So let that be a lesson to you, that there are multiple code sections that define what if you are a related party. Make sure you're in the right one, okay? So I think pretty much most people got that right, but then I was like, oh, that was supposed to change the answer. So I was thinking of the wrong code section. All right. So Code Section 267B has the relationships, and the one that we care about is yes, Part 2, B2. An individual and a corporation more than 50% in value of the outstanding stock of which is owned directly or indirectly by or for such individual, B2. So what that means is, to be a related person under these 267 rules, the shareholder has to own more than 50%. Okay? So we have to own more than 50%. There are lots of other 267 rules, but this is the only one we care about in this context. FYI, brothers and sisters are related under Code Section 267, but not under Code Section 318. And there's actually even more related party code sections out there. So make sure you're in the right one. All right. All right. So, not pro rata. Honestly, there's not a whole lot to explain. Not pro rata means not pro rata. And we'll see an example of that in just a minute, okay? But it is what you would think it is. Note, though, this is important. If you have multiple properties that you're distributing and multiple shareholders, the shareholders not only have to receive overall their pro rata share, but they have to receive their pro rata share of each property. So this is not in the cumulative sense. If they have 3 or 4 properties and there are 2 or 3 shareholders, each one of these shareholders is going to have to receive a pro rata amount of each property that is being distributed. Okay. Of course, an easy way to get around that is to do what? Exactly. Sell them all to some third party, take the cash, and then distribute the cash pro rata. Okay?
Can you sell to one person, that one person has their own deal from the vanilla product?
Say that again?
Like if you sell everything to one person, then that person have their own deal going on. You can do that.
Yeah, you could sell all the assets to one person. In fact, you probably would. Sell all the assets to one person, or sell them to 3 or 4 different people. So long as you are not selling them to another related party under Code Section 267. Okay. Let's see. It's so hot in here. Okay. Now, under the next one, so again, if you fall under this, then you cannot, the distributing corporation cannot recognize a loss. Now, if you fall under this one, we still under the related party rules, but the property is disqualified. Disqualified property is defined in the code under D1B. And it says, the distributed property was acquired by a liquidating corporation in a Section 351 transaction or as a contribution to capital within the 5-year period ending on the date of distribution. So I'll just abbreviate that, okay, and say 351 transaction, although it doesn't have to be. It could be just a contribution to capital, which did not technically qualify as a 351, but a 351 transaction within 5 years before the distribution. Okay. Okay, now let's talk about D2. One very important thing to know with D2 is D2, you do not have to be a related party. Okay? These related party rules that are required under D1, not relevant for D2. Okay? So please make sure you remember that. Let me also say this right here. Under this rule and this rule, the entire loss is disallowed. Under D1A, 1 little I, to D1A, 2 little i's. Okay? D2 only disallows pre-contribution losses. So what are the rules in D2? This limitation, I'm going to read it out of the code. D2. It is under D2B, 1 little i's. That's where it talks about how you know if you apply. Such property is acquired by the liquidating corporation in a 351 transaction or as a contribution to capital, and it was part of a principal purpose, basically to recognize loss by a liquidating corporation. So, what we have is a 351 transaction or contribution to capital, okay? 351 transaction and principal purpose to recognize loss in a liquidation. Now, this is a little bit stricter than what first meets the eye. We have a rule, if you keep reading, look down at 2B, 3 little i's. Certain acquisitions treated as part of a plan. For purposes of clause 1, which is what we were just looking at, any property described in clause I, 1 little I, acquired by the liquidating corporation after the date 2 years before the date of the adoption of the plan of liquidation shall be treated as acquired as part of a plan. So, if it is acquired within 2 years of the plan of liquidation, it is treated as this second part. Okay? So, what happens if you have a related person and a disqualified property, and it was acquired within 2 years of the date of the plan of the liquidation.
You hire a lawyer.
Well, you don't actually have to. It basically says, 336D1 applies. If both this and this applies to the same transaction, we're gonna use this rule instead of this one. Why do you think Congress would say that?
Isn't the first rule better? You can disallow all the loss?
Isn't that bad, isn't that worse?
Oh, yeah, you're right, yeah.
Are we going back to
That's
eighty what?
That's probably why, because it sucks.
Yeah, exactly. This is not taxpayer friendly. So if we have a taxpayer and they fall under both D2 and D1A, two little i's, I think it's the regs. Say, I didn't look it up to see exactly where it says that. Oh, just a sec. It's in the regs. I'll let you know on the break, I'll look it up and find exactly where it says it. But D1A, two little i's trumps D2. So that is worse, right, for your taxpayer because they can't recognize the full loss. Whereas this rule only says the corporation can't recognize a pre-contribution loss. So, does everyone see the difference? See what we're talking about here? Okay. So let's do a problem. Okay, I'm sorry I forgot to take it out. You have some stuff in your handout on page 7 and page 8. It's all highlighted. I forgot to take that out. That was from a different book. So the problem on Wilbur and Dayton is not actually in your book at all, and we're not going over it. In fact, I was supposed to take out all of this. These are my notes, and there's a lot of things misspelled. So you're not, I was supposed to leave it all. But it's in here, so you get it. So, let's do a problem with Ivan and Flo. This is on page 340. We are going to do problem 1, but not problem 2. Okay, so. Here's my picture. Anyway. Okay, so here we have X Corp. And we have Ivan, which owns 60%. And then we have Flo, which owns 40%. The corporation has no liabilities, and it's going to liquidate, okay? We're gonna liquidate. These are the assets it has. We have Gain Acre, which has a $100,000 basis and a $400,000 fair market value. We have Lost Acre, which has an $800,000 basis and then a $400,000 fair market value. And then we have $200,000 of cash. Okay. So let's go through the different scenarios here. If X distributes each of his assets to Ivan and Flo as tenants in common, in proportion, well, as it does say, on January 1st, X adopted a plan of complete liquidation, and we have to assume that each asset has been held by more than 5 years, unless they tell us otherwise. Okay? So, X distributes each of its assets, so we have 3 assets essentially, to Ivan and Flo as tenants in common in proportion to their stock interests. Okay, so tenants in common, so your prompt for your memo, the two taxpayers own the property as tenants in common. Some of you may not know what that is, you maybe looked it up. It's not a tax term at all, it's a property law term. And all it means is that the two people are going to own the property jointly. They are both going to own the property together. Okay? So, they are distributing all of these assets to Ivan and Flo as tenants in common. So we want to know what the tax consequences are. Okay.
And now we have to do both, like the code rule and then RS.
That is for the consequences to the shareholder.
Okay, and now we have to
And,
incorporate.
yeah, and in that situation, we had, a liquidation in year one and a liquidation in year two. Here, all of our liquidations are going to occur in the same year. We're doing it all at one time, as one plan of liquidation. We don't, it's called a creeping liquidation. We don't have a creeping liquidation, which just means over 1 year. Okay. All right, so we want to know the tax consequences here. So, the corporation, is the corporation going to have to recognize any gain from the distribution of gain acre?
Yes.
How much? $300,000, that's right. So X is gonna recognize $300,000 in gain from gain acre, nothing for cash, right? What about loss acre? Is the corporation going to be able to recognize that $400,000 in loss from loss acre?
No.
Well, we have to go through our rules, okay? So, here, we are not gonna fall under this rule, right? Because we're assuming that all the assets were purchased more than 5 years ago, okay? Here, well, first of all, we don't know that we have a 351 transaction, right? It doesn't say that, at all. I think it just says, yeah, it doesn't say that it was acquired by a 351 transaction. But, what about this rule? So, do we have any related people here?
Yes.
Who?
You want to think well?
Are they both related parties?
No, Ivan.
Ivan, or whatever his name is. Ivan, yeah. Only Ivan is a related party. Flo is not. So, we know we have at least one related party, so the piece that goes to Ivan of loss acre may be disallowed. But what else is required under D1A 1 little I? Is it pro rata? Yep. So what does that mean to the corporation?
Then we can recognize 60%.
They can recognize the whole loss, the whole thing, for loss acre. So X is going to recognize a $400,000 loss from this liquidation.
Why you can recognize only Ivan's because Flo is not.
So remember these rules, you have to meet both requirements, right? So here, yes, you're right. Only Ivan is a related party. So only Ivan would potentially kick in this rule or this rule. But this other part has to be met too. So these rules turn off the loss. Does that make sense? Like, kind of see what I'm saying? These rules turn off the loss recognition. So in order for the loss recognition to be turned off, you have to have a related person. And we do. We have Ivan. But the distribution was pro rata, so that means that the entire loss is going to be allowed. Not just the part that is related to Flo. which will happen very soon. So, and these, honestly, these rules are a little bit tenuous. I have to go slow when I do them to make sure I'm in the right code section and I'm seeing it correctly, okay? So, let me see where I am now. Okay, actually, how much gain is Ivan going to recognize? So I don't think it tells us what the basis is, what their basis is in their shares in this problem. No, it doesn't. It doesn't tell us. But if you were to go to calculate Ivan's gain, Ivan would have, basically 60% of the gain and 60% of the loss minus their stock basis, basically, which we're not given in this problem. Okay, flow would be the same at 40%. Okay, so now, same as A above, except that X distributes the loss acre and the cash to Ivan and gain acre to Flo. So now what we have is loss acre, cash to Ivan, and then gain acre to Flo. Okay, so the corporation, they're still going to recognize the $300,000 of gain from gain acre. Yes, that's not changing. All we're really looking at is, okay, are we going to be able to recognize this $400,000 of loss from loss acre? So what we have to ask, okay, do we have a distribution that's pro rata? No, now we do not, because we look at it property by property. And since Ivan is getting all of loss acre and Flo is getting all of gain acre, it is not now pro rata. So we are going to fall under D1A, one little i's, right? Because we have a related person, right? We have Ivan, and the distribution is not pro rata. So that means that that $400,000 of loss is not allowed.
What's under the B?
It's under D1A.
No, but the problem, are we doing B or it's still A?
It's B. Yeah, it's problem B. Yeah, problem B on page 341. Okay, so no loss recognition. Under D1A, one little I. Okay. Now, C. Same as B above, except that X distributes gain acre and the cash to Ivan. So now we have the gain acre plus the cash, and the loss acre to Flo. So I'm not going to say it again. Gain acre, they still have to recognize $300,000 of gain. The corporation does. But what about loss acre? Can we recognize a loss acre? What do y'all think?
Isn't company not allowed to distribute only to one person? They need to distribute to both, all the,
She owns less than 50% anyway, so that wouldn't disqualify.
Exactly, that's right. Because loss acre is going to Flo. Is Flo a related person? No. Since, even though, yes, the distribution is not pro rata, you're right. But the lost property is going to someone who is not related. So what does that mean? Do we get to recognize our loss? Yes or no? Yes, that means we do get the loss. So the corporation recognizes their $400,000 loss.
So losses are only disallowed if the related person gets the loss?
But yeah, right, both of these things have to be met, right? Both of these things have to be met for the lost property. So if you look, right. Because it says under the code, no loss shall be recognized to a liquidating corporation on the distribution of any property. So when it says no loss is recognized, what that means is it has to be the lost property, basically, that we're looking at. Okay? So, now let's look at the next one. Same as A above, except X acquired Lost Acre as a contribution to capital 4 years ago, and X was not required to reduce its basis under 362E. Do y'all remember 362E? Do y'all remember that code section? So code 362E, which y'all discussed in chapter 2 via lectures, is when, online lectures, and when you have a shareholder that's contributing a property with a built-in loss, and if their the aggregate basis is greater than the aggregate fair market values of what they are contributing, then the corporation, instead of getting a transferred basis, their basis is going to become the fair market value. Do y'all remember that code section at all? All it said is you're not going to get to preserve the built-in loss at both the shareholder and the corporate level. That's all that code section stands for. But same as A above, except A acquired Lost Acre as a contribution to capital 4 years ago, and X was not required to reduce its basis. There's an election. You can choose whether you want to do it or not. So now we need to now we need to look here. So where exactly are we going to be here? So, sorry, I lose track here. Same as A above. A was that we're giving each asset to Ivan and Flo as tenants in common. So now I'm going to write that. Ivan and Flo, tenants in common. After this problem, we're going to have a break. Ivan and Flo is tenants in common. All right. So since we know that is this one going to apply? No, we've already said that, right? Because the distribution is pro rata. Okay? So we're not going to fall under D1A, 1 little i's. What about under D1A, 2 little i's? Do we have a distribution to a related person? Yes. Ivan. So Ivan is our related person. And is there a disqualified property? Yes, there was a property that was acquired in a 351 transaction 4 years ago. So we want to determine, is this loss going to be disallowed? Not the entire amount. Only the percentage that goes to who? Ivan, right? So that means 60% of the loss is disallowed and 40% is allowed. Because 40% is going to Flo, who is not a related party. So, what is 60%? $240 disallowed, and then 160 is the amount that's allowed. Okay. So when Ivan receives, hold on, let me look at my notes, make sure I'm reading this right. Right. Okay. Sorry, just a second, I'm reading something in my notes that's screwing me up. That's interesting. Okay. So my notes talk about this, which, I don't know that the answer he does or not. I don't think it does, but it says Ivan and Flo, these are the properties that they are receiving. So under 334A, which is the provision that discusses basis basically, this provision says that the distributee, so Ivan and Flo, their basis becomes the fair market value of the property. So even though Lost Acres' basis is greater than the fair market value, Ivan and Lowe's basis in this property that they're now receiving is going to be $160,000 for Flo and $240,000 for Ivan. So they're going to basically receive the fair market value basis under 334, not step up. Ivan is not going to get any kind of change, neither will Flo, under this code section 334. Okay. Now what about if the Lost Acre had a value of $1 million and an adjusted basis of $800,000 when it was contributed? Does that change our answer under D1A2 little i's? What y'all think?
What can you say again?
So what if, at the time of it was contributed, because this was a 351 transaction, so 4 years ago, there was a fair market value of $1 million and a basis of $800,000 for Lost Acre. So would that matter? It doesn't matter, because remember, the entire loss is disallowed. Whatever piece is related to gain or loss before it was contributed is not relevant under D1. It is relevant under D2. Remember, D1 is the harsher rule, which says the entire loss is disallowed. D2 only disallows the loss pre-contribution period. But for D1, we don't really care what it was when it was contributed. We only care that it's a loss now. Okay? All right. And then if we look at E, what result on the distributions in C above? So now, I'll write this up here so we don't forget. We have Gainacre in cash to Ivan. So we have Ivan gets Gainacre in cash, and we have Flo is getting Lost Acre. Okay, so we have Flo getting Lost Acre. If Lost Acre, which had no relationship to X's business operations, were transferred to X by Ivan and Flo in a 351 transaction 18 months prior to the adoption of the liquidation plan, when Lost Acre had a fair market value of $700,000 and an adjusted basis of $800,000. So it was transferred 18 months ago in a 351 transaction with an $800,000 basis and $100,000 fair market value. So, now, are we going to be under D1A, one little I? No, why? Because Flo is not a related person. Same reason under 2. Flo is not a related person and she's the one receiving Lost Acre. What about D2? Do we care that Flo isn't a related person for this? Nope, doesn't matter. Under D2, we have to have a 351 transaction and the principal purpose is to recognize loss in a liquidation. The code says that if the property was acquired within 2 years of the date of the plan of the liquidation, we need this, okay? So what that means is here, right, under this scenario, D2 does apply, right? So now, we are going to have a limit on loss recognition under D2. How much loss is going to be disallowed? Is it going to be 400,000? What do y'all think? So this rule only says the pre-contribution loss is disallowed. So what is the pre-contribution loss? 100,000, right? Because it had an $800,000 basis, $700,000 fair market value. So that means we have a $100,000 loss disallowed or not recognized, and a $300,000 loss allowed. Okay. That's it. We're not doing problem 2. So let's take like a 10-minute break and then we'll come back.